Kunal Vora joins us now, Head of Equity Research with BNP Paribas. Kunal, good morning. Thank you for joining us. What do you make of this market setup? Suddenly things are looking topsy-turvy. Mid and small cap stocks are almost melting. Do you think there is more pain left in the market?
We believe so. If you look at mid and small caps, they had a very strong run. Like in 23, 50% returns, last year, 25% returns. Valuations do look stretched for the broader markets. Like there has been some correction, like 10% correction, which we've seen in the last couple of weeks. I think that makes it a little bit more palatable, but we still find a lot more comfort in the large caps, especially if I look at large cap valuations right now. They are starting to look like a lot more reasonable. Like if I look at 24, the returns were not great, like single digits. And we've seen already some correction. So the key parameter which I look at, bond yield earning yield gap, that's starting to look a lot more comfortable.
So how much more pain is left in mid and small cap stocks? And the grain of the truth here is that everybody has exposure to small and mid cap stocks. So what should be approach with small and mid cap stocks? Get out, take a hit, convert to large cap stocks, or raise cash, or stay invested? How should one approach that category of stocks now?
I would still say a wait and watch. Over the last couple of years, what we've seen is the money is coming largely from domestics, and a lot more money is going into the mid and small caps and thematic funds. Also, a lot of retail and PMS money is coming to mid and small caps. That's resulted in the space getting overheated. And I don't think a 10% correction from the peaks is really a big correction. In the past, we've seen prolonged corrections. And I think this can be a grinding market, like for some more time. From FI perspective, it doesn't look like they will come back in a hurry. In the last 4 years, we've seen 3 years of selling. I think one of the key reasons for that is the elevated US bond yields, which are still at 4.5, 4.55%, which has just come off a bit from the highs, but still very, very elevated. In that context, FI money may not come in, and there is also a lot of local supply of equities which is coming in. And it's all being supported only by the domestic flows right now.
Question that everyone is toiling with is it too late to now make that switch from within small and mid caps out to large caps? I mean, should one just profit take across the board if you are holding on to any profits in your small and mid cap portfolio? Of course, at an individual level.
I do see more value in the large cap space. We think private banks offer attractive valuations, along with potential earnings rebound and growth rebound in FY26, especially with the liquidity infusion which we've seen. We also do see value in IT services, where the growth outlook is better compared to what we've seen in the last couple of years. So outlook management commentary seems good there. And we also see value in the telecom space. Again, most of these are really in the large cap space. On the broader markets, we still find valuations higher compared to what we've seen in the last 5 years. And especially if I look at point to point, like where the valuations used to be 7, 8 years back versus where they are right now, the valuations still look reasonably expensive. And I do believe that for the year as a whole, large caps is the place to be in.
Now the other question, of course, is how much more pain within mid and small caps? And I know we can't go into individual stocks or sectors also over here, but at an index level, given that we've fallen so hard, how much more correction do you think is in the pipeline?
So our view for the year is that Nifty will give about 8% return for the year, and we believe that mid and small caps will underperform. So we've already seen some of that underperformance play out, but maybe a little bit more, and then it starts becoming a little more attractive. But Indian markets are expensive compared to global markets, while we are now looking reasonable compared to our own history. Markets as a whole are expensive, and mid and small caps premium compared to the Nifty was very close to an all-time high just a few weeks back, and even now it's still elevated compared to the averages.
What is the benchmark to say this is the right price to buy large cap and this is not the right price to buy large cap? I mean, would it be historical averages? Will it be future earnings? What is that combination which will, in a sense, convince you that it's time to start buying fear irrespective of what is happening in the world?
So there are various parameters. If I look at just like say Nifty P right now, about 18.8 times. The historical average is about 16.5 times. What also needs to be factored in is that GDP growth and earnings growth have slowed down a bit after 4 years of very strong earnings growth. We've seen some moderation. if I look at high frequency indicators through the course of the last year, we've seen some moderation in high frequency indicators. So what's really helping the markets has been domestic flows. And as long as that remains, it's possible that Nifty finds support here. But from a FII perspective, the outlook does not look great even now. And valuations are not very compelling. But I do believe that, like, say, from large cap perspective, as I mentioned, the bond yield earning yield gap, which had been as elevated as 2%, is now come down to 1.5, as Indian bond yields have come down from the 7.1, 7.2 levels to 6.8, and earnings yield also has improved because of the slight derating which you've seen at Nifty level.
Indian IT sector was getting hit by AI. Now AI is likely to get hit by Chinese AI. So I just shudder to think what will happen to Indian companies.
So Indian companies are coming off for 2 years of fairly weak growth, mid-single digit kind of constant currency growth. Typically, what we've seen is when you've seen couple of years of weak growth, there is a strong rebound. This year, at least in the earnings commentary which has come by so far, the companies are indicating that things are turning around a bit. But I do agree that, like, say, AI is a long-term risk for not only IT services, but, like, say, for employment and, like, for economies. It can be fairly disruptive force in the coming years. But I do see the recent developments as slightly positive for India. Like, low-cost AI will make it adoptable for the masses, and, like, structurally it could remain low cost. It's something which I see as a positive for India.
Hi Kunal, this is Shrishti also joining in. Good morning. Just wanted to understand that what has been your reading from the earnings so far, because a lot of these positive announcements or maybe some of the positive results are also being ignored by the markets in such an environment. But what has been your reading in any sectors that you wish to flag off? You did talk about IT, but other than that, we also have some of the good numbers being reported by the auto companies. So given the correction, any sector that you wish to flag off?
Let me start with, like, consumer space as a whole. We believe that mass consumption continues to remain under pressure. Urban mass consumption also is now coming under pressure. That's really reflecting in the numbers of consumer staples, which have seen almost no volume growth, which is fairly surprising that these kind of businesses, which are expecting higher level of penetration, higher level of adoption, they are seeing no volume growth. And even outside this, we've seen the volume growths to be fairly muted, reflective of what's happening with the economy. There's been some slowdown in high frequency indicators and GDP in the last few quarters. That's one. In case of autos, we believe that for two-wheelers, for this year, volume growth will be lower compared to what we've seen in the past year. But there is some margin comfort which we continue to see for the sector. In case of IT services, numbers have been fairly in line, but commentary was positive. Banking, again, a mixed picture, but, like, the recent liquidity infusion is something which we see as a positive. Overall, still an evolving earnings season, but it's mixed picture so far. But last couple of quarters, we've seen a fairly broad-based cuts in earnings.
Okay. What, to your mind, is the real reason why FIs are selling India? And when do you see that turning? And do you see that turning at all?
So FIIs remain fairly important for the market. They still hold about $800 billion of Indian equities, still holding about 1.6 times compared to what the domestics own. In my view, what's happened is the elevated interest rates in the US, they make emerging markets unattractive, especially an expensive emerging market. So if I look at last 4 years, we've seen selling in 3 years. Before that, in 10 years, we saw selling only in 1 year. And that's really started along the time when the US interest rates started moving up. Like, when you have US 10-year offering 4.5%, plus you factor in the currency depreciation in India, the market does not look super attractive, especially considering where the valuations are right now. For the FIs flows to come back in a big way, I think earnings growth needs to rebound, GDP growth needs to rebound, and even the US interest rates need to cool off.
Okay, I'm just going to mark the market, just turn attention and see that what do we have. Banks are holding on. I wouldn't say they are really, looking absolutely rara or gaga. Nifty has started slipping from the day's high. Oh no, the banks are slipping also now. So Kunal, where are PSUs? Is the party really over in PSUs? Because there were a lot of these exciting themes in PSUs, railways because of government capex, defense because of Atmanirbharta, roads because of government spend, aviation because of a new sunrise sector. All those themes have taken a back seat. Can they come back, or can they come back, or it's going to be a long winter for them?
See, PSUs have had a massive re-rating in the last 5 years. If I look at like a like of CPSE ETF, it's been like 5-bagger in the last 4-5 years. So they've had their good times. They've seen an earnings rebound, and the government focus was very clearly on capex while managing the fiscal deficit. Going forward, it's going to be a little bit more challenging. We've seen, like say, budget is coming next week, but what we have seen is the GST collections have slowed down a bit, with earnings growth also slowing down. The corporate tax collection also has slowed. Government collections are being driven by personal income tax, which is being driven by the increase in capital gains tax rate. On the expense side, they might need to prioritize on the revenue expenditure because mass consumption is really struggling right now. So the capex might take a backseat. Even in FY25, it's going to clearly lag the budget expectations. And in FY26, again, we believe that it might not be a big priority. The kind of increase which we've seen in the past, that may not come in. So within the capex side, we believe that power, data center, etc., could continue to see strong capex. But some of the strong capex which we've seen in case of roads, railways, that's something which may not come back in a hurry.
The other thing is, I mean, theoretically, while we know that a spike in US yields is what's impacting the FII flows, but when do you think this, linkage is going to disconnect?
This linkage will remain. I mean, India cannot really operate in a silo. There is still about $800 billion of holding which FIIs have, and what we've seen in last 1 month is hardly $8 billion of selling, which is 1% of what FIIs hold. So it's not that FIIs, while their holding has gone down from about 20% in peak to about 16% now, they still remain fairly important participants. So I don't see the linkage breaking completely. Incremental money is coming from the domestic side, but at the same time, FIIs will remain relevant for the market.
We are just a few days away from the big day, that is budget day. So any expectations or any hopes from the budget this time? Any thing that the market participants are looking forward to?
I think one hope which may not play out is any big tax rate cut. I mean, I think considering the finances right now of government, it's going to be difficult to provide any large stimulus to the consumption side, especially the personal income tax rate cut. While there might be minor tinkering, I think having any expectations of major tax cut is something which may not really play out, because any such tax cut will only benefit about 28 million people who pay taxes, while what the government might need to prioritize is mass consumption, which has been struggling a lot more compared to affluent consumption.
All right, Kunal, really appreciate your time and thank you for joining us.
If you like this video, then like, share and subscribe to ET Now.